Hello and welcome to another episode of FINtalk Market Update, the first one in 2023. Today we're going to be touching base on what happened in January, what we expect in 2023, and start to gauge where the market actually is, and what are the biggest factors playing part where we are. With January started the earnings season. That's when companies report their earnings the past quarter and some of them on the entire year. So far, it's looking good for many companies across many sectors like healthcare, consumer staples, and even IT, despite the layoffs. They're showing good and positive year-over-year revenue growth. In addition, GDP data for the fourth quarter of last year came out and it is positive. Actually, it's better than expected. Unemployment remains strong despite all the layoffs, and inflation is heading the right direction, with CPI headline at 6.4 and PCE headline at 5. But this is not at the pace the Fed wants it, neither we do. To that point, we also had another 25 basis point rate pushing the Fed rate up to 4.75 almost. But it seems that the market already had that priced in, and now the one-year Treasury is yielding almost 4.85%. So, fueled by good earnings, positive GDP, and the consensus, whether that's right or wrong, that the Fed is going to pivot soon, the market rallied in January, especially small cap and tech. That's the NASDAQ. Small cap, you can see it represented by the Russell 2000. That was not a surprise, as usually small cap is historically more volatile and it tends to move ahead of the broader market, whether upward or downward. Now, despite delivering strong numbers, the equity market understands the job reports under a different light. Low unemployment means more room for the Fed to continue its rate hikes. And more rate hikes, that means more downward pressure on the equity market. Meanwhile, the yield curve is getting closer to becoming flat. In short, we think the Fed doesn't want the equity market to rally before inflation is back to historic average, that is between 2 and 3%. And despite the revenue growth shown in earnings report that we talked about earlier, companies seem to reduce their growth expectation for the upcoming quarter and the one after. This follows the narrative of a slowdown, but not necessarily a recession. Nonetheless, the Fed is pushing the narrative again and it's willing to push the market even to a recession to normalize inflation again. Thank you for watching. I hope it was both informative and enjoyable. If you'd like to see more of our videos, please check out our content library. See you next time.